All right, ladies and gentlemen, welcome to episode 61 of TCP. On today's episode, we are going back to school. The reason being, we have markets and mayhem. is on the pod, but before we bring him in, Noah, what's going on, bro?
Alejandro, what's good? The last two times that we had Eminem on the pod, they were probably two of my favorites that we've done. And so I'm excited for this one, obviously. And I want to say he's the only three-time guester on TCP, maybe outside of Mander.
I was just thinking that. Him and Mander, maybe, which is appropriate. Because if you guys listen to the Mander episode that we made recently, he gave his 2023 outlook. We all know that Mander is a perma bear. And I'm very, very interested to hear what Markets and Mayhem has to share with us on this episode. Welcome back to TCP. It is an absolute pleasure having you back on, my man.
What's up, Alejandro? What's up, Noah? It's so great to be back with you guys, and it's a pleasure to be back a third time and a privilege. I really appreciate it, and this is a great show to participate in. I think you guys are awesome hosts, so thank you for having me.
Thank you, sir. We really, really appreciate that. So, as I was talking about just a few minutes ago, the reason we want to have you on, or wanted to have you on, is because we want to hear your 2023 market outlook. You're, of course, very, very vocal. The last time we had you on the pod was, I believe, during the summer of 2022. So the market was rallying, and the market was trading over 4,000. And I remember Noah and I sitting on the pod, and you were talking all this stuff about, oh, the market's going to trade lower. It's a bear market rally. And as I was listening, I was like, the thesis that you had built was extremely strong, but I couldn't quite see it in the moment, which is why I started off the podcast by saying that is going to take us back to school because we're about to do some more learning. Go ahead and get started. Tell us what your 2023 outlook is shaping out to be. What do you think the market has in store? What are your thoughts?
Sure, absolutely. Thanks for the opportunity. And I kind of feel like we're going to have a bit of deja vu because, the last two times you had me on, it was during a bear market rally. And I took the kind of contrarian view that this is not sustainable and we're going to hit new lows. And so I'm going to walk you through where we've been and where I think we're going. And I'm calling this presentation the Turbulent 20s, because how could we call this era anything different? So the first thing we've got is price increases from a year ago. This is inflation in our face. Food up 10.1%, housing 8%, services 7.5%, energy 7%, all items 6.4% at the headline level. Core 5.7%. This is way too high for the Fed's comfort. And core services inflation, something that Powell specifically mentioned as an area of concern, continues to accelerate, which is not what they want to see. Further, the Federal Reserve has said that they're concerned about wealth effects and the impact that that's had on bringing people out of the workforce. So if you think about it, let's say you're late 40s, early 50s, you got really lucky in the market, maybe it's real estate, stocks, bonds, all together. They're saying we want those prices to go down because, sad as it is to say, we want to bring those people out of retirement and into the workforce because right now there's 1.7 jobs available for every one person seeking work. And if you think about it, that's not the environment where you're going to see wages really start to drop back in the growth levels that the Fed wants to see, which is closer to 2 to 2.5%. Whereas right now, year over year wage growth is like 4.7%. So it's fallen a bit. That's encouraging, but it's nowhere near where we want to see things go. So the Fed has responded to all of this with one of the most aggressive tightening cycles we've ever seen. If you look at the trough of zero bound to the peak where we are right now, just above 4% on the upper bound rate, that's the fastest acceleration in rates we've ever seen. But wait, there's more. Because we're also seeing the balance sheet of the Federal Reserve and other central banks running off at an accelerated pace. In fact, it's the biggest drain of liquidity that these central banks, including and especially the Fed, have ever engaged in. Why does that matter? Because when we look at this in prior episodes, first of all, rare that we see a negative blip. And when we do, it's pretty ephemeral in nature. Yet this time is different. that year-over-year change of central bank liquidity is pronounced to the downside. So you see sort of deleveraging coming from the top down, from the central banks to the banking system and to market participants themselves as we see margin debt collapsing. Now, this is healthy. You do want to see participants deleverage. We have these valuations. I think the Shiller PE is just shy of 30. One time that it was over 30 or just at 30 was Black Tuesday before the Great Depression. Now, I'm not suggesting that this time is like that, but what I'm saying is valuations are far too high. You don't want a new bull market paradigm to start with a Shiller PE of 30, because what that suggests is it's going to be a shallow short bull market and not a lot of people are going to make much money. So this margin debt collapse, it started, but I don't feel like we're done yet. And obviously we're waiting for the FINRA data from December of 2022. But in my mind, we need to see this come down 50% or more, probably more, given how high it got going into the last sort of post-COVID run. So in my mind, I want to see this down over 50% year over year change, just to show us that market participants are deleveraging such that, maybe, just maybe, we're starting to see some level of the smoke clearing, that people aren't sort of frothing at the mouth bullish on this market. Now, there are other areas of the market that I look at that concern me too. When you look at household net worth, the exposure that they have to equities is near record levels. When you look at institutional investors, they have taken out their exposure in the US. They've taken that down to raise some cash, but they've deployed a lot in emerging markets and in Europe. So it's not so much that they're bearish, it's just that they're deploying to different parts of the world. So none of this really suggests that we're sort of at the other side of this, that we're seeing the sort of deleveraging and the raising of cash that we'd like to see, to say that maybe, just maybe, the next bull market is starting. Further, we've never seen a bull market the last, I think, 6 times start with a Fed hiking cycle. It typically starts not only after the Fed pivots, but after they ease aggressively. And let's talk for a second about why the Fed would pivot. Because one of the big things that we keep hearing on social media and elsewhere is that, the mythical Fed pivot unicorn is going to come and save stocks from themselves. Well, what if that doesn't happen for the reasons that people want? That is to say, if we have a soft landing, there's no reason for the Fed to pivot at all. If the economy comes back into more routine growth levels, if inflation becomes subdued, the Fed can keep rates high. But to have an actual pivot, an aggressive cutting and quantitative easing, we need to see some kind of crisis. That's what people are hoping for, whether they realize it or not. That's what would spark the kind of pivot that people want. Now, when the Fed first pivots, typically the market goes down another 15 to 20%. So it's not even the initial Fed pivot that we want to see. We want to see the deep down and dirty pivot where they're going into zero bound policy and quantitative easing again. The question is that going to happen? And I'm a little bit leery. The reason that I'm leery is because I think we're in a structurally different economic and financial environment. Not only has inflation been high, but it's been high because of factors that are outside of the Fed's control. We have an inelasticity of supply, right? So there's just not enough energy. There's not enough agriculture. There's not enough raw materials. There's not enough transportation. And so if demand is ever to come back online in a way that is, say, commensurate with similar early to mid credit cycles, it's going to happen at a time where prices are likely higher than they were, right? Because this inflation is slowing, but prices aren't dropping. It's just the rate that they're appreciating is slowing. So prices coming up from a higher base, but also demand rising at a time where supply remains constrained. The X factor here would be if there's any kind of fiscal policy to expand supply. Better energy policy, better agricultural policy, better raw materials policy could all help. But instead of that, we're getting demand construction on the fiscal side. That is to say, the government is coming in and saying, hey, you know what we should do? We should pass the CHIPS Act. We should pass the ironically named Inflation Reduction Act. And I'm completely apolitical about this stuff. I'm just looking at cause and effect. And the effect is more demand at a time where the Fed, even themselves, has said, you know what we need help with? We need help with supply. We'll take care of the demand destruction the best we can. We need help with supply. How do we get there? The only way we get to that world is sort of this supply side economics. We need more exploration and production in energy. 2022 was the worst year for energy discovery since 1946. That's not telling us we're getting more supply. Copper reserves, the amount of supply that we have there is extremely low. So is the exploration and production of it. So if we get into a new bull cycle, a new credit market, people are building new EVs and solar farms and wind and other kinds of infrastructure, copper prices are going to surge too. And then we've got a lot of problems with agriculture because of increasingly unstable weather patterns. We've got, agriculture that's quite frankly unsustainable in the way that we're doing our farming. So all these key input factors are remaining supply constrained in a world where demand is being subdued by the Fed. But what happens when the Fed takes their foot off that beach ball that's been submerged underwater? Demand pops up. And in a world where there's insufficient elasticity of supply. So I think that, even when we do eventually get to a new bull market and credit cycle, and we will eventually, after the Fed pivots, it might be shorter and more shallow than what we have been used to in the last 30 years of sort of disinflationary economics. So that's something that I concern myself a little bit, because if we look at the Goldman Sachs U.S. Financial Conditions Index, we're not making the kind of progress the Fed wants to see. They've said they want sufficiently restrictive monetary policy such that it leads them towards their goal of 2% PCE. And PCE is well above 2%. So to see this, and it's sort of like it's a bit of evidence that the market is fighting the Fed, it's not a good sign. During the December press conference and the minutes that were released subsequent to that, the Fed made it very clear that they're concerned that the more that the market fights them, and part of that fighting is evidenced through financial conditions, the more that they're going to have to be restrictive, that they're going to have to keep rates higher for longer and run off their balance sheet more. And we'll get more to the QT part of it in a second, because that's pretty important. But in essence, financial conditions, that Fed speak, it's just really the Fed saying that they need stock and bond prices to come down. That's really what financial conditions mean to us traders and investors. So when the Fed says financial conditions are too loose or too easy, what they're really saying is stock and bond prices need to come down. So I want to pause there in case you guys had any questions or any feedback about what I presented so far before I go on.
For sure. So you've given us a lot to think about here in just the first 10 minutes. And one of the things that I think people focus on, particularly retail, is the Fed, right? It's a common saying, don't fight the Fed. And I think it's sort of common knowledge, and like you said, sort of almost hopeful thinking that eventually the Fed is going to pivot and things are going to go back to normal, right? And so when people look at, okay, what's the Fed sort of looking at here? And Powell broke it down for us really simply in like three sort of different categories that he looks at, right? So there's goods inflation, which he talked about sort of being a result of like more so COVID, right? Like it's not really a sticky structural driver of inflation. It was really more so supply side thing that's going to get worked out. Goods inflation is going to come down. Secondly, sort of that rent portion of the inflation, which, is sort of expected to continue higher for, a little bit more several months because it's a bit lagging, particularly with 2022 and how that looked in sort of the housing market. And then third, you have like that core services outside of shelter where the Fed really pays attention, right? And so even looking at that core services factor, you have the 3-month average of month-over-month core services, I want to get this right, at 0.1% right now, which I think puts it in line with like 2.5 to 3% annualized. So when people look at that, I feel like the bull case that people try and construct is, okay, by the end of this year, inflation should have come down enough that the Fed should feel comfortable pivoting, and that people are sort of trying to front run that, right? Yes. And they're saying, okay, if they're going to pivot in the second half of this year, let me buy my stocks right now, even if there's still a little bit more downside to go. We're closer to the end than the beginning. How would you counter that bull argument that it seems really apparent that people are trying to sort of put forward as a reason to buy stocks now?
Yeah, I mean, I think that the biggest concern I would have with that argument is the last 6 bear markets didn't end until the Fed not only meaningfully pivoted, but they were really, really cutting rates aggressively. Further, those bear markets only ended when we were in a recession and when households were raising cash by selling their equity positioning and when margin debts were being reduced by over 50% year over year. We haven't seen any of those indicators come online yet. I'm watching them pretty closely here. Now, of course, this time could be different. But with the duration and extent of yield curve inversion, I don't think it's going to be. Whether we're looking at the 3-month to 10-year or the 2-year to 10-year, those inversions are really quite profound. And they suggest to me that, we've got quite a ways to go until we start to see the total impact of Fed policy on the economy. We just had the Empire State Manufacturing Index plummet the most we've seen since, I want to say, the Great Financial Crisis. And we've also had ISM services plunged the most since COVID, and before that ever. Now that's going to feed into earnings, as is disinflation. So when we start to see this slowdown in the economy, in services, in manufacturing, companies are going to make less money. Then you add the backdrop of the disinflation that we want and we have to see. I mean, you eat, I eat, everyone eats, right? We all need food, we all need energy. We want to see those prices at least stop going up, or at least stop going up as fast as they're going up. But that disinflation, that lack of appreciation in pricing, and eventually drop in pricing is going to be really bad for companies because it's going to cause top and bottom line compression. So you're going to see earnings impacts from slowing business conditions, from stabilizing to falling prices, and from a consumer that's quite frankly stretched. Now let's remember, the consumer is 2/3 of the US GDP, and 2/3 of consumers are struggling. They're living paycheck to paycheck. They're leveraging up into credit card debt to pay for necessities, whether it's food, utilities, even housing. And that's a big problem because now the rate of that credit is appreciating. All revolving credit is going up. In fact, the average credit card, I think, has about a 20 to 25% APR. So for those folks, they're now paying more and more and more just on the interest of this debt that they have to utilize because their wages haven't kept pace with inflation since the 1970s. And so this tells me that the majority of the economy, whether it's consumers or businesses or even governments that are dealing with more difficult borrowing conditions, is slowing. And I think that that kind of portends to the notion that we're not even through the first half of this kind of economic and financial dislocation. Now, of course, I could be wrong and I might eat humble pie. Maybe this is the first time ever where we have a really good soft landing, where we have this new bull market start from some of the highest valuations we've ever seen. Again, around 29 on Case-Shiller. That doesn't leave us a lot for upward price movement. And then we got to ask ourselves, if we're looking at PE, the P is price, the E is earnings. Well, I just talked about how earnings are likely to go down further, which would mean the PE ratio goes up, making stocks even more overpriced than they are currently. So it's hard for me to paint a picture from a fundamental perspective or a macro perspective of an encouraging sort of bullish backdrop. And if we do get a bull market, who wants to be bullish with prices this high on many different parts of the market? So it just concerns me a little bit that there's this sort of foaming at the mouth euphoria. We've only come down, I mean, at this point, 800 points on the S&P from where we were in January of 22 at the high to where we are now. That to me doesn't suggest that we've seen the kind of haircut commensurate with the sort of recession and slowdown in business conditions, and not just a economic recession, but an earnings recession too. And that's all kind of playing into the idea that I think stocks are still quite overvalued. Now, look, I don't want to be a bear. I don't like to be a bear. I would much rather be out there and saying, oh man, there's all these great opportunities at excellent valuations. I'd love to be getting long-term invested in this stuff. I just can't see that right now. What I'm looking at is a market that is fighting a Fed that for the first time in most people's lifetimes, unless they were around in the 70s and 80s, they're adamant. I know why people would want to fade Powell. He's pivoted in the past early. Remember December of 2018, that sort of tightening tantrum that we had? Everyone's thinking that this is an analog of that. This is very different because back then we had lower than Fed policy inflation. It was lower than 2% PCE. Imagine a world with low inflation for a second, right? Wouldn't that be nice? And then we also had the economy really starting to slow down. And there were some cracks showing underneath the surface in the repo markets. We've got the exact opposite now. We've got an economy that's running hot. We've got high inflation. We've got an excess of liquidity in the short-term markets. The Fed's got plenty of room to continue to do what they want to do. And I think they have every motivation to keep their word. Now, people always say, well, how can you believe the Fed? They talked about transitory, this, that, and the other. There are two bits of Fed speak to differentiate. There's the economy side and there's the policy side. On the economy side, they're generally blowing hot air. They're still talking about a soft landing. They're still talking about the potential to kind of get out of the worst of this. They're never very genuine on the economy side because they're managing expectations. If you told everyone we're going to have a deep recession or, God forbid, a depression, well, how would people behave? It would manifest the outcome. But on the other side, with policy, they're very, very forthright from the entire time since COVID started. The Fed came out, in 2020 and famously said something along the lines of, we're just going to put all the money out there we possibly can. There's no limit to the amount of stimulus we'll put in the financial system. That was the truth. And then throughout 2020 and 2021, they talked about how they're going to continue to do that because they're concerned about some of the fragility that they see in the economy and financial system. And they did. And then as we got to the later part of 2021, they said, we're going to start tightening soon. They did. And then in early 22, they started to say, meeting with Neil Kashkari on January 4th, that they're going to do QT and it's going to be more aggressive along with their rate hikes than what we've ever seen. And they did. And so all of this has been spot on. They've been the most transparent Federal Reserve we've ever seen in the history of financial markets. So I don't think now is the time to start fading Powell's credibility. So my base case here is A, like you said, don't fight the Fed. B, the fundamental situation is worsening. C, the macro situation is worsening. And then we also just have this addiction to liquidity. QE has been the lifeblood of financial markets for so long. There's a strong positive correlation between the balance sheet of advanced central banks and the performance of equity markets like the Wilshire 5000, S&P 500, et cetera. That correlation hasn't broken. It's very likely that as liquidity continues to leave the financial system from the Fed in the amount of about $95 billion a month of their QT, that the price revisions for equities is going to be lower. And here's the big takeaway. No one's talking about QT. Everyone's talking about when the Fed's going to be done hiking rates, when they pause. And the pause is coming. Maybe it'll be 5, maybe it'll be 5.5, maybe 6%. It'll be all to do with inflation and economic data. But QT is actually a bigger deal because it's draining that same liquidity that made this sort of 14-year bull market possible. And if you're taking that out of the financial system and you're seeing financial conditions deteriorate, and you can see it in kind of how the things have been trading, they've been pretty illiquid. Last year, the treasury market was incredibly illiquid, currency markets, the stock market. We saw some of the worst trading conditions that we've seen in quite a long time. That tells me that until that liquidity really starts to come back in, that we're not really at a time to be decisively bullish. That, quite frankly, I wouldn't be surprised, and I know this is going to sound a little shocking, but I wouldn't be surprised if the S&P trades below 3,000 before this is all over.
That's what the people wanted to hear.
Hey, Noah, what do moving averages, RSI, and MACD all have in common?
They're all lagging indicators from the 70s with weak ability to predict future price action.
Exactly. Modern retail traders need modern trading tools. That's why we've partnered with Rocket Scooter, an artificial intelligence and algorithmic charting tool that predicts where high volume will occur before it happens.
That's right. Rocket Scooter's 15 unique indicators help visualize in real time where institutional players are interested on almost any stock and gives you a clear-cut game plan for how to take advantage of the underlying mechanics of the market.
A platform like that probably costs a ton of money.
Well, for 7 days, Rocket Scooter will offer their groundbreaking technology completely free. Then, once you decide you're ready to become part of the Rocket Scooter community, for a limited time only, Rocket Scooter is offering 50% off their monthly subscription for life, as long as your membership stays active. Use the link in the show notes to get started using Rocket Scooter for half price today.
All right. So, I've got some questions for you. So you kind of laid the groundwork. All right. Now moving forward into 2023.
Yeah.
As an investor, as a trader, are there any parts of the market that you find particularly, the equities market, that you find particularly attractive? And then I'm also going to ask you which areas you are completely avoiding, wouldn't touch with a 10-foot pole. We'll start with things that do look attractive, may outperform headed into this year.
I'll just stick with the first quarter because we're in such a short-term environment that it's very hard to make longer-term prognostications. And I'll say that for me, I like metals and materials. I think that that's an area where as long as we have China start to come online, that's going to be an area where there's some relative strength. You can see XME has been outperforming SPY. If you put them on a ratio chart, you can see there's a relative strength there. I think industrials are another interesting part of the market. Energy, I'm a little hesitant about. I like it, but I think that they ran so much last year that they might need some breathing room before they can run again this year. I also like emerging markets because a lot of emerging markets are commodities producers that are going to benefit from an environment where commodities prices probably aren't going to come down to where they were before. And there's that same inelasticity on the supply side that as prices maybe become more buoyant, particularly with the China reopening, if it really does play out, that they could be beneficiaries of that. So that would be kind of where I'd be looking on the long side.
I'm really quick before you go into the ones that you don't love.
Yeah.
What do you make of because you mentioned energy and potentially something that you would be looking at, and you said that you don't love how much they ran last year. What do you make of sort of the divergence between some of the energy stock prices, XOM, et cetera, and the actual performance of oil, like especially towards the second half last quarter of 2022?
It's absolutely fascinating. It really is, because you don't typically see those kinds of price divergences. And I'm glad you brought that up, because that is the crux of my concern, since this is an industry that has pretty high operating leverage. So they are sensitive to those costs, right? And to the amount that they're able to make for their output. Now, on the one hand, ExxonMobil out there in the Permian Basin is able to pull oil out of the ground for about $20, $30 a barrel. So they're doing okay, right? They're still able to sell for more than double what their cost is for pulling that oil out. On the other hand, I want to be very specific as to where in the energy market I want to play. I don't want to be anywhere else right now than oil services. Oil services are the folks that are going to help people explore and expand production. And they are in much higher demand than I think previously. So Schlumberger, Halliburton, companies like that have my attention right here, because they're in the sweet spot. Another area of the market I neglected to mention that I would want to consider being long here are treasuries. And I'm talking about bills and notes, specifically the 3-month bill, the 6-month bill, and the 2-year note, because it's an attractive yield. If you hold the coupon, it's a risk-free return. And quite frankly, it's getting to the point where it's matching or beating inflation. And with that risk-free component, it makes it more attractive to me to consider parking some cash there while I wait for some better opportunities.
Yeah, that's a great point. I actually talked about that with Coach Tipka this morning. He I believe his financial advisor got him into his first T-bill ever.
There
and
you
so
go.
He was excited about that.
And think about it, like for 14 years, these things were like not yielding anything. They were yielding low inflation. They were like, just a joke. But now we're getting to them to a point where you got to kind of look at them at least out of the side of your eye and be like, so I can get basically 4.5, maybe 5% yield. And all I do is sit down and I don't have to glue myself to every freaking candlestick on the screen. Where do I sign up?
That's literally what he said. He was like, "There's no way." Like he was like, "This sounds too good to be true." It's like that's definitely how they work.
And then you had those I-bonds last year that were yielding close to 9%.
Yeah, crazy. I do remember that as well. All right, parts of the market that you're looking to avoid this year.
Everything in ARC. I really think the long duration risk. Yeah, I mean, Kathy, I wouldn't. Right?
There you go.
I mean, this is just a part of the market that I don't want to touch, because I'm very macro-centric, top down. And so I look at the credit cycle to make some of my investing decisions and allocations. And when you're end cycle, like we are now, rising rates, slowing economy, things are getting kind of nasty out there. That's the last part of the market you want to be in. It's because of what we just talked about. If you can get a high risk-free rate of return, why would you speculate on the other edge of the risk curve for things that may not make any money, and in this environment have a much higher likelihood of bankruptcy? So biotech, growth, unprofitable companies, I don't want anything to do with them in this environment. And quite frankly, I might not want anything to do with them in the next cycle, because my theory is the next cycle is going to be led by old economy stocks out of necessity, because not only are those going to be the parts of the market we need to invest in, but those are probably going to be the parts of the market that outperform, because they're going to be selling things at higher prices, appreciably higher prices than prior cycles. And that's going to make them pretty attractive to me.
That bodes poorly for Alejandro, who on one of our Beat the Bell shows actually picked ARC as
not in front of MM, not in front
as a hot take.
Hold on. Let me paint the picture here. They asked for a hot take, and I gave the single hottest take anybody could. That was the
sizzling hot.
And I said Kathy Wood is going to outperform the S&P. So if in 12 months from now I'm correct, I'm going to look like an absolute genius with zero downside risk when I said it, because it was the hottest of hottest takes. So
I will say, as a trade, I think it works. You got a lot of short interest in these stocks. They can bounce. We've seen short covering driving a lot of these upward price revisions and sort of the bubble stocks. So I think on a short-term basis,
they're all already up like 50% year to date. They're exploding.
I mean, year to date, they've had a really strong start to the year.
Like 20% year to date already. I mean,
it's terrifying, isn't it?
It's crazy, man.
It's nuts.
I will say this much, that if Tesla wasn't in ARC, it'd probably be up 40% year to date, right? With the amount of that Tesla's gotten completely wrecked. But look, I mean, I think that we will come to a time where this sort of innovation paradigm will be the place to go. I just don't know if it's anytime soon, because unless and until we fix the supply side inelasticity, inflation is going to be a longer term specter. It's becoming more structural in nature. It's no longer a cyclical phenomenon. And that's to do with, we need more supply in energy. We need more supply in base metals. We need more supply in agriculture. And until we address that, I think that the next time a cycle comes on, when we have a new credit cycle, a new bull market, the Fed's easing and all that, when demand comes online, the prices of that stuff are not only going to rise, but they're going to rise fast and from a higher base. And that's why those cyclical old economy stocks could be the outperformers during the next bull market. But I think it'll be a shorter, more shallow bull market because the Fed's going to have to step in earlier to fight that inflation earlier in the credit cycle than they typically would.
That makes sense. I want to ask you now about something you touched on last year, which is the 60-40 portfolio. And it's funny that this was, I want to say this was on your first episode. What was it, like early March, Alejandro? Like either February or March, something like that. And the year hadn't really even gotten that bad. But one of the things that you mentioned is that, early on the 60-40 portfolio, that 60% allocation into equities, 40% allocation into bonds wasn't doing so great. That's generally, one of the safer ways that you can structure a portfolio.
Yeah.
And last year you had obviously yields rising, bond prices coming down. And then obviously the stock market had one of the worst years in recent history anyways. Yeah. And so the 60-40 portfolio had one of its worst years, I want to say, in several decades, 3 to 4. Over the 10-year average, it's still averaging like 3 to 4% a year. So, I mean, it is somewhat doing its job, I guess. What do you view about the future of that sort of allocation going forward? Is that still sort of the bread and butter for somebody who wants to be invested long-term but doesn't want to take a crazy amount of risk?
So, I mean, I think starting a 60-40 portfolio, particularly the 40% allocation here into longer duration U.S. debt is probably not a terrible idea. We're probably going to see some price appreciation in the 10s, 20s, and 30s as we get closer to recession, and we see more and more kind of people becoming concerned and buying those. But on the other side, the equity portion probably won't do so well this year. So I think the bond portion could give you some cushion from the downside in equities because bonds got violently routed. It was one of the worst year for bonds. If you look at global bonds ever, if you look at U.S. bonds, I think it was one of the worst years in several decades. I think for the 10-year note, it was one of the worst years in many, many decades. So I would say that, just because of the amount of selling we've seen, and now there's some buoyancy in the bond market. The last week, we had the 3s, 10s, and 30s have B-plus auctions across the board, that we are seeing appetite come back. But I'm a little concerned about the bond market, and I'll tell you why. So, we know that the U.S. government is running a huge deficit. That deficit is set to grow because interest expenses on the U.S. debt are probably going to grow to about $700 billion a year. And the question becomes, who's going to be the natural buyer? I think that eventually, at some point, the Fed does have to restart QE because there's just too much of a debt burden. Now, when the Fed was doing QE, they had this magical little thing happening. And that is that when the Fed buys treasuries and those treasuries pay the Fed yield, the Fed nets out their expenses and they pay the rest back to the treasury at the end of the year. So it's kind of like having an interest-free credit card. The U.S. government cannot afford to pay today's rates, not for a long time. It can afford to pay it for maybe a couple of years, but after that, the Fed is likely to have to come back because I don't think other countries are going to be as aggressive buyers as they had been prior. We've seen Japan kind of get pushed out of the treasury market last year due to currency hedging costs. We've seen China become net sellers because of geopolitical tensions. Saudi Arabia joined them. Russia's already sold most of their holdings there. So I think that we do have to consider kind of what's going to be the driver of upward appreciation in price and downward revisions in yield. I don't see a whole lot. I think we could go lower because of recession fears. But beyond that, I think the government has to straighten out its balance sheet. It has to straighten out its budget. And with $700 billion being spent on inflation, that's almost the DoD budget, which is just over $800 billion. And the DoD budget is the largest part of the government's budget. So that's going to make a big dent, and they need to do something to reconcile that, whether that's going to look like austerity, like big old budget cuts that really hurt people like you and I, or whether that's going to look like the Fed coming back with QE. Time will tell. But for now, I'd be, looking at bonds over the very long term and saying, they'll probably be okay as long as inflation doesn't come back and rear its ugly head. Now, for people who are holding these things to the coupon maturity date, It's not a big deal. It's a risk-free rate of return unless the U.S. defaults on its debt. And by the way, debt ceiling debacle starts this Thursday, right? So we'll let the Kabuki theater commence. But for now, I would say that it's not a terrible place to be for 2023, particularly on the longer end of the yield curve, looking for that recession trade. But I would be concerned about the 60-40 portfolio, particularly because of the 60% allocation into equities. And here's why. What is that 60% allocation? Typically, it's passive investments, right? What's the S&P 500? 500 stocks, but 5 stocks make up 20% of it. So every $1 you put in the S&P, 20% of it's going to 5 mega caps. That doesn't seem like a great thing, particularly because those mega caps are underperforming the S&P and even further underperforming the equal weight S&P. So I'm a little bit concerned about how some of the bigger components of the S&P are going to perform in an environment that they're not used to. Remember, these things were outperformers from 2012 forward. So they had basically 9 years of outperformance. It really stopped in 2021. Now, moving forward, I think if we go into that picture of an older economy kind of leading, then the sort of composition of the S&P, what's going to be outperforming is going to change. And there's a big chasm between old economy stock market capitalization and where these mega caps are, suggesting that the mega caps could drop quite a bit more and these old economy stocks could appreciate, but not enough to make up for the difference. So I would be a little bit concerned about that. But I would say if that 60% allocation is in international stocks, potentially emerging markets with much lower valuations and better yields, then I would be a little bit more bullish about it.
All right, Mem, I want to ask you what you feel is the largest lesson that you personally learned in 2022 and whether or not that same lesson can apply to the average investor. So if it's something different, how we can kind of phrase this question is what you learned in 2022, biggest lesson, and what investors should have learned if they didn't already learn in the year 2022 that can help them invest or trade in 2023.
So here's a chart of the mega caps versus the big 5 central banks' balance sheets. The mega caps are in dark blue. Central banks' balance sheets are in light blue, and we can see there's a pretty strong positive correlation between the increase of leverage in central banks and the price appreciation of these stocks. Similarly, as we're seeing these central banks running off their balance sheets, these stocks have lost value and are likely to continue to do so as long as that continues. So I'd say the biggest lesson I learned in 2022 was just how synchronized the leveraging was on the way up. And as we saw last year, on the way down, everything moved the same. There was things like I'd put up a chart of the Russell 2000, Amazon, and the Nikkei. They'd all look the same. Imagine that. They're completely different. They couldn't be more different. You've got an index of some of the worst companies on earth. You've got an index in another country. And then you've got Amazon, and they're all acting the same. Then you look at Bitcoin, you look at mortgage-backed securities, you look at the 10-year note, you look at corporate debt, high-yield debt, you look at stocks like the NASDAQ, they'd all be behaving almost identically. Obviously different scales, right? But the same type of deleveraging. So what I really learned last year is just how interconnected everything became after 13 years of emergency level stimulus and on and off quantitative easing in this market. And that to me suggests that we're nowhere near out of the woods, particularly when we look at this chart and realize, hey, passive investing funds, they're all tied up in this nonsense. These same stocks are 20% of the S&P and 40% of the NASDAQ. And most people in America, when they're investing in the market, they're just putting it into these passive funds that are market cap weighted. So market cap weighted funds, passive investing, it might start to look a lot different in the future. I think active investing is going to have a role. And I think equal weight passive investing in things like the S&P 500 is also going to have a role. In fact, here's a fun statistic. If you were to have created a long short basket, long the S&P equal weight, short the mega caps, and let's say you put that on in February of 2021, you would have been up over 80% over the following, the 2 years to come after. And that's just how badly these things underperformed and just how much the equal weight index outperformed. So what I would say is I don't think that's over yet. I still think equal weights will outperform the mega caps. I think the mega caps have a lot of downward correcting to do because their valuations still don't make sense with the kind of growth trajectories they have. And unless and until that changes, which won't probably be until the Fed, again, you can see on the chart here, starts to grow their balance sheet, I think that we're in a difficult time for this idea of FANG-centric investing or passive investing in market cap weighted indices.
A lot of those companies too, it's interesting, were treated rightfully so as growth companies for so long. And when you get to the size of an Apple, the size of an Amazon, the size of a Microsoft, finding that growth just becomes so much more difficult, you would have to imagine, for companies that size.
Yeah, I mean, eventually they have to be basically like the only company doing what they do on Earth to be able to continue that kind of growth trajectory, and it just becomes unsustainable. I mean, I like tech a lot. I have a background in tech. I understand how these companies work, and some of the things they do are very innovative and exciting, and they've certainly changed parts of the world for the better. But at the same time, we have to look at this realistically and say, is Apple really justifiably a $3 trillion company that's going to grow 30% a year? Or is Microsoft, $2.5 trillion or similar in size with that kind of growth? And it's just eventually you have to answer no, particularly when you see what happened after COVID, when all this liquidity flooded into the financial system. You can see it here. I mean, look at that run in liquidity after COVID. I mean, there's the great financial crisis response, but then there's the post-COVID, let's just throw all the money in the world into the market response. And that's just not sustainable. And so a lot of that growth was from, multiple expansion, buybacks reducing float, and of course there was earnings growth, but not as much as what would have warranted the price revisions.
Right. Great point. You mentioned earnings. Let's dive into it with earnings season having started just this past Friday with the banks. What are you looking for in the earnings reports for Q4 of 2022, which are going to come out, have already started and are going to continue to roll in, with the largest of which should be in the next couple of weeks at the beginning of February. You mentioned earlier that, you're sort of expecting to see that EPS growth drop, the price earnings multiples come down in a lot of these names. Is that something that you're expecting to see as early as Q1 this year when these earnings come out, or what are you sort of looking at with these companies expected to report in the next couple of weeks?
Sure. Yeah. So first thing, I want to give a shout out to my business partner, Aisha, who is a fundamentals expert. She can read a balance sheet like no one else I've ever met, has 18 years of experience in banking and managed over $2 billion. So she's one of my mentors. And she's been looking at this through the lens of, we're seeing some very disconcerting signs from these major banks. JP Morgan and Bank of America, as well as Wells Fargo, came out. They had to write off a lot of bad debts from people that are basically not able to pay. And they're putting out even larger loan loss provisions, saying that this is going to get worse before it gets better. So they're telling us through their massive lens, I mean, this is where the majority of deposits and banking activity happen in this country, Citigroup being like basically the other of the big four, they're telling us that things are not so good with the consumer, who's 2/3 of the economy. So that's telling us one big piece, right? That people are increasingly stressed. And while those delinquency rates, that distressed debt rate is not of a concerningly high level yet, it's a bit of a lagging indicator. And we're already seeing signs with their loan loss provisions rising that they think things are going to get worse. So those are likely to rise. So that would be one thing that I'd be looking at going into earnings season when we start to see the big techs. One of the things that I was concerned about the last several earnings seasons was this sort of sequential deceleration. A lot of the time we just look at companies year over year. Year over year is kind of meaningless for a growth company. We need to know what they're doing quarter over quarter. And when we looked at the Googles, the Amazons, the Teslas, even Microsoft, we started to see signs of sequential flattening, if not deceleration of growth, or in some situations, a lack of growth completely. And that's really, really concerning because these companies, their valuations are predicated on sort of growth ad infinitum. So if we start to see that, and I think we will even more in this earnings season, I think it's going to have a pretty big impact on the S&P and the NASDAQ because of their concentration in these same stocks. On the other hand, we also see these companies are starting to lay people off, so that's going to help a little bit with cost cutting. They're downsizing their office space, which eventually will help, but for now they're going to have to pay some fees to get out of these leases early or sublease them to other tenants, possibly take a haircut on what they're earning versus what they're paying to their landlords. But ultimately, I think that we're in for, even with the quarter four earnings season that we're getting into now, where we're looking at last quarter's earnings in the first quarter of this year, I think it's going to be choppy. I think that a lot of these companies are going to disappoint. Goldman Sachs came out today, had a huge earnings miss. I think it was a 60+% miss. And I don't think that kind of bad performance is going to be so rare in this type of situation that we have. And that is to say that in the interim, where we're kind of navigating into the initial innings of an earnings recession, I think we're going to start to see more and more signs, not only with the backward-looking earnings, but the forward-looking guidance that things aren't so hot and that we have to continue to revise lower. So I expect there to be not so great earnings. I think that some of these companies will come in line with expectations, but only because expectations have been revised lower so significantly. But I also think they're going to give us guidance that suggests that they don't see any rosy sort of future in their next quarter or even the quarter after that. That really, a lot of these companies are going to look at 2023 as a difficult year because of the convergence of factors we've talked about. Rising interest rates, appreciating the cost of capital. Some of these companies have revolving lines of credit, others have to refinance. We see a slowing consumer and more difficult business conditions that are kind of slowing demand for a lot of them. And then we see these companies that overspent, they overhired, they had too much office space, and they're having to kind of admit to the world that things aren't going so well, so they actually have to downsize quite a bit. And Amazon's one of the biggest, where they had to get out of a lot of this warehouse space they had for their e-commerce. They've had to sublease some of the room on their jets to be able to, basically not have to get rid of that surplus capacity they put online for logistics. And they've had to fire at least 18,000, probably more to come. But I think that this is sort of a sign that first it started with techs and the big layoffs and the warnings and earnings, even as early as 2021 with some of the smaller ones. And it's going to work its way up to financials and to other parts of the economy as time goes on. And this disinflation or eventually deflation, even though we're going to rejoice it as individuals and consumers that live in this economy, companies are not going to do so well in that environment. We might see some signs of that start to trickle into this earnings season as well.
It's interesting because there's been, it seems like every other day, right? You have a top 100 company basically announcing a hiring freeze or layoffs, and you wonder how much longer it can continue, but it really hasn't shown any signs of slowing thus far. It's just a steady pace of layoffs throughout, particularly tech, like you mentioned. And yeah, it's starting to work its way out. Even some of the banks, Goldman most recently, with a lot of their layoffs. So yeah, that's something that I sort of expected to be at least on its way out by now, but it just doesn't seem to be slowing down at all.
Well, remember, Noah, that one of the things that the Fed has said is that they need to kind of soften the labor market. It's far too tight for them. They're very concerned about that there's that 1.7 jobs available for every one person seeking work. And that's untenable because you can't get wage growth to really decelerate towards Fed policy targets without having unemployment higher, without having less jobs available. And that means there's two different things that have to happen. For one, wealth destruction needs to bring more people out of early retirement. And I hate to say it because I don't want to see anyone suffer. I live in this country too. But at the same time, the Fed has said that they don't see any other way because they're fighting policymakers. They're fighting people in the market. They don't have a choice but to try to erode that artificial kind of wealth bubble that's been created in stocks, bonds, real estate, crypto, things like that. And they're adamant and they kind of have to do it. And if they are successful, you're going to get more 40, 50, 60 somethings back in the workforce. So that'll help. There'll be, more people seeking jobs. And so eventually there'll be more open jobs kind of being filled. The other part of it is you see the Fed increasing the cost of capital, and that's likely to make companies have to eventually fire more people because the cost of running their debt is increasing. And every month that rates are held high, even if they stay at the same rate, it's going to have a compounding effect. It's going to have a further and further tightening effect because more and more companies are going to have to finance at those higher rates, realizing that higher cost of capital. And while the last thing that companies want to do is lay people off, they are getting to that point because they've cut costs everywhere else that they can. And so eventually we do reach that moment where they start to have to say, we don't have a choice. We don't want to do this, but we're going to have to let a lot of people go. And I think that we're only in the early innings of these layoffs because as long as the Fed is kind of tightening and as long as the economy is showing some signs of stress, and I mean, look at what we just had with the Empire State Index, look at what we just had with ISM services, both manufacturing and services is a really big part of the U.S. economy, are telling us in no uncertain terms that mythical soft landing is nowhere to be found, that we're in a plane without a landing gear and we're descending rather fast.
All right, MM. Before we go, the final question here. This is a fun one just because I'm kind of curious. Apple, at what price would you be buying?
So I would look more at valuation, but what I really want to see. So Apple, their biggest item that they sell is their iPhone, right? And if you're in an environment where you don't have as much discretionary funds, what are you going to do about your phone refresh cycle? You're going to buy more or less? You're going to buy less, right? You're going to say, maybe I can keep my iPhone for 3 to 5 years rather than replace it every year. And you're going to say the same thing about your Mac. You're going to say the same thing about kind of a lot of their core offerings. So I think Apple is due for a bigger slowdown. I would not be too surprised to see this thing in the double digits before this is all over. And I think that some of the structural technical breakdown that's happened in Apple's really quite disconcerting. It's basically just sort of counter trend bouncing back to a key trend line of resistance. I'm not so sure that Apple is going to come away from this thing unscathed. I think that it's one of the big titans that has yet to really catch down to the reality that its other peers have seen. So, I'll take a stab in the dark and say somewhere between $60 and $80, but to me, it's not going to be about the price of the share. It's going to be about the valuation that we see and whether or not consumers are coming online commensurate to where they were before. And if I might, I just want to put on one more chart before we go, because I think this is a real eye-opener. So about half of volume on the S&P 500 options are being traded with 0 days options, these sort of 24 hours or less to expiration options. And this has been such a big part of the market. And I remember in 2021, everyone wanted to kind of on the institutional side, kind of put their nose up and say, oh, it's all these retail punters and these single stocks that are buying this zero DTE, the Lottos and Lambos crew. Well, now apparently institutions are doing the same thing. And in big, big size. And so not last Friday, the Friday before, we got that ISM services print at 10 a.m. and it was very, very recessionary. We saw this huge, huge, huge reaction in S&P call buying. It was a sort of idea that bad news is good news. And so we saw just pounding away at the 39.50, 39.60. I'm pretty sure those were the strikes. And it got to the point where it was the largest single day of S&P call buying ever in the history of the market. And the SPX options market is the biggest options market of any options market in the world by far. It dwarfs every other index. It dwarfs all single stocks put together. So when you start to see delta squeezes at the index level, it starts to suggest that we're in an environment where people just don't know what to do. You don't have any conviction in a market where the majority of your activity is happening the same day. That's saying, like, I don't know what's happening in a week, a month, a year, but today I have some directional bias. And that adds to this sort of leptokurtic distribution of tail risk, right? Because if you have this much activity in an already illiquid market, it makes it very easy for concentrated players to move the price around significantly. So that's one big thing to watch out for. Whether you're a bear or a bull, price movement is becoming more erratic because the market has now become sort of driven by a paradigm where the dog is sort of being wagged by its own tail. The tail being the options market, the dog being the stock market. And that's not a good thing. That's something that can lead to greater and greater systemic risk. And it's one of the reasons the market has had this habit of sort of crashing upward, but it also leads to greater potential for the opposite because we're in a very, very poorly hedged market environment. Skew on the S&P 500 is at lows that would suggest that if we do have an exogenous left tail event, that things could get pretty disorderly to the downside. Because think about it. If you're in a situation where you haven't bought fire insurance and your house is on fire, and now you have to buy it while your house is on fire, in effect, the way that works in the market is you're pouring kerosene into the fire, right? And on the other side, if you have to exit your long positions in that situation, it's also pouring kerosene on the fire. Either one, whether buying puts on the SPX, VIX calls, or selling positions is taking liquidity out of the market. So that sort of feedback loop, if we had a really nasty volatility catalyst to the downside, could start to feed on itself and become pretty disorderly.
Yeah, that's something that they introduced the everyday expiring options like towards the end of last year. And I think that for day traders, it was like, oh, this is awesome. Like you get 0 DT every day. Like this is pretty cool.
Yeah.
But at on a larger level, I know that a lot of people with a deep understanding of how the options market actually affects the stock market, especially at the index level, like you mentioned, we're citing some concerns, and it's a situation where I feel like we won't know until it actually happens. Like people won't realize like how impactful of a change that is until, like you said, something bad actually does happen, and we see that sort of feedback loop sort of pour on itself. So I completely agree. It'll be interesting to see how that affects the market going forward this year.
And Noah, let's just look at some analogs in single stocks. So in 2021, we had Upstart, Asana, Affirm, and Cloudflare as these sort of delta squeeze kings. And then we had Tesla, which is the biggest example of that. It was the highest single stock premium and volume almost every day of the year. And every time one of these things unwinds, we discover just how big the pocket of hot air was below that drove it up. I don't think it's going to be any different this time.
Love it.
All right, It was an absolute pleasure having you on, per usual. This was great. The 2023 Outlook episode with Markets and Mayhem. This was an absolute gem. I will 110% be re-listening because you talk a little bit too fast for me and you just kind of pump out information. So maybe 2 or 3 listens, honestly. But the presentation was just phenomenal. I mean,
I loved it.
You came extremely prepared. I love it. Again, absolute pleasure having you on TCP. Cannot wait to get this episode out. You're the man. Thanks again for joining us.
Thank you, Alejandro. Thank you, Noah. Wishing you guys a great rest of your trading week. And thank you, as always, for being such gracious hosts and inviting me back on.
Absolutely. All right, Noah, another awesome episode. I'll see you next week for episode 62.
Yep. Thanks again to MM, and we'll see you guys next time.